Three pressure points moved today. China quietly shifts military balance in the Gulf. Gold's safe haven thesis strengthens. And the system that prices gold briefly failed. Here's what actually matters. China-Iran missile alignment. Iran is reportedly close to acquiring advanced supersonic anti-ship cruise missiles from China, weapons capable of threatening major naval vessels in the Persian Gulf. The reported system, the CM-302, travels at high speed and is designed to evade interception. This development comes as US-Iran tensions remain elevated and naval presence in the region has increased. If completed, the deal would deepen military cooperation between Beijing and Tehran at a moment of fragile regional stability. Why it matters today? The Strait of Hormuz carries roughly a fifth of global oil supply. Anti-ship missile capability changes the risk calculus for energy flows, shipping insurance, and military deterrence. This isn't just an arms sale, it's a potential shift in the balance of power in one of the world's most economically critical waterways. Markets price stability. Weapons that challenge naval supremacy introduce volatility. JP Morgan raises long-term gold. Forecast to $4,500. JP Morgan has lifted its long-term gold price forecast to $4,500 per ounce, citing sustained central bank buying, geopolitical fragmentation, and structural demand for hard assets. Gold has already been trading near elevated levels amid persistent geopolitical tension and uncertainty around global growth. Central banks, particularly in emerging markets, have continued to diversify reserves away from dollar-denominated assets. Why it matters today? When major banks revise long-term targets upward, it reflects more than short-term fear. It signals structural repricing. Gold is not just reacting to crisis headlines. It is being repositioned as a long-duration hedge against geopolitical fragmentation, currency risk, and systemic stress. If institutions shift allocation models, flows follow, and flows move markets. CME Metals, trading, outage. The Chicago Mercantile Exchange, through its COMEX Metals platform, experienced a technical outage that halted trading in gold, copper, and natural gas futures for roughly 90 minutes. During that time, price discovery stopped. Liquidity vanished. Orders could not execute. In volatile conditions, that matters. Trading has since resumed, but the interruption occurred while gold and energy markets were already sensitive to geopolitical risk. Why it matters today? Markets depend on functioning infrastructure. COMEX is foundational to global metals pricing. When benchmark exchanges freeze, even briefly, it introduces execution risk, settlement uncertainty, and potential distortions in pricing. In calm conditions, it's a glitch. In fragile markets, it exposes structural vulnerability. China's potential missile deal with Iran raises regional risk in a critical energy corridor. Major banks are structurally repricing gold higher, and the exchange that prices gold experienced a trading blackout. Geopolitics, capital flows, and market plumbing, all moving at once. That's your GAINN Daily Brief.